Every financial decision you make has two prices. The first one is obvious. It's the number on the receipt, the monthly payment on the contract, or the total at the bottom of the checkout screen. The second price is much quieter. It's the life that money can no longer build because it has already been assigned somewhere else. Most people spend years learning to recognize the first price. Very few ever learn to recognize the second. You see it almost every Friday without realizing it. Your paycheck arrives before you wake up. By the time you pour your first cup of coffee, the direct deposit is already sitting in your checking account. For a brief moment, every possibility still exists. The money hasn't been told where to go yet. Then the month begins collecting it. Rent leaves first. 3 days later, the car payment follows. Insurance renews automatically. The credit card statement closes. A few subscriptions renew while you're at work. You don't receive notifications for most of them anymore because you stopped paying attention months ago. Nothing unusual happens. That's exactly why this matters. Financial mistakes rarely look like disasters while they're happening. They usually look like ordinary Tuesdays. A few weeks ago, the Federal Reserve released another report showing that household debt had reached another record high. Credit cards, auto loans, mortgages, student loans. The headline sounded dramatic. The reality usually isn't. Most people didn't wake up one morning and decide to borrow more money. Life simply became a little more expensive than it was last year. Groceries cost a little more. Insurance premiums quietly increased. The apartment lease renewed. The old laptop finally stopped working. One decision led to another until the monthly cash flow adjusted itself around a completely new version of normal. That's how financial pressure usually grows. Not all at once, one reasonable decision at a time. You can almost trace it backward. The apartment felt worth the extra $200 because it cut 20 minutes off your commute every morning. The newer car felt worth another $90 a month because the old one had become unpredictable. The unlimited phone plan cost a little more, but it removed one more thing you didn't want to think about. Every decision solved a real problem. None of them felt irresponsible. That's the part people often misunderstand. Consumer behavior isn't driven only by impulse. More often, it's driven by justification. If something improves your life, even slightly, your mind becomes remarkably good at explaining why it's worth paying for. The decision feels rational because, in isolation, it usually is. The problem only appears when every isolated decision begins competing for the same paycheck. Imagine someone earning $75,000 a year. Not wealthy, not struggling, just comfortably somewhere in the middle. A raise arrives. $5,000 a year. Roughly $400 a month before taxes. At first, it feels meaningful. You imagine finally creating some financial breathing room. Then life responds. The apartment you've been looking at becomes affordable. The dealership sends another email offering lower monthly payments on a newer model. Your current phone qualifies for a generous trade in credit. The gym near your office is running a promotion. Individually, none of these decisions consume the raise. Together, they consume something much larger. Choice. Economists have a phrase that rarely appears outside classrooms. Opportunity cost. Most people learn the definition once, pass the exam, and never think about it again. But opportunity cost never stopped shaping their lives. Every dollar only works once. Spend it here, and it can never work somewhere else. That's true whether you're buying coffee or buying a house. The difficult part is that the future never sends invoices. The investment you didn't make doesn't appear on your bank statement. The emergency fund you never finished building doesn't send reminder emails. The business you never started because cash flow was too tight doesn't show up beside your checking account balance. The future is remarkably quiet. The present isn't. The present sends advertisements. The present offers financing. The present promises convenience. The present tells you that you deserve it. The future usually says nothing at all. And silence is very easy to ignore. The strange thing about opportunity cost is that it almost never feels like giving something up. It usually feels like making a perfectly reasonable decision. Walk into almost any furniture store on a Saturday afternoon. A dining table costs $1.800. The salesperson doesn't start by asking whether you want to spend $1.800. They ask whether $68 a month feels manageable. The number changes. The decision changes. The table doesn't. The same thing happens with cars. The same thing happens with phones. The same thing happens with vacations. The total slowly disappears. Monthly payments take its place. Businesses understand something about human behavior that most people never stop to think about. A large number forces comparison. A small monthly number invites acceptance. That's why almost every expensive purchase today arrives with financing already attached. The question is no longer, can you afford this? The question becomes, can you fit this into your monthly cash flow? Those are completely different questions. Suppose your monthly income after taxes is $4.800. Your rent is $1.650. Your car payment is $520. Insurance costs another $210. Utilities average $180. Groceries come to around $650. Subscriptions total $94. Your phone plan is $82. Before you've bought a birthday gift, replaced a tire, gone out with friends or saved a single dollar, more than half your income has already been assigned somewhere else. Nothing on that list looks irresponsible. In fact, most financial advisors would probably agree that every individual expense is understandable. That's why budgets often fail. People assume budgeting is about controlling spending. More often, it's about seeing commitments that became invisible because they happen every month. There's a reason accountants talk about fixed expenses before they talk about investments. Fixed expenses determine how much freedom survives after payday. Every recurring payment quietly competes against future choices. A higher rent doesn't only cost another $250 a month. It also reduces your ability to change careers. A larger car payment doesn't only affect transportation. It changes how long you can survive without a paycheck. A vacation paid with financing doesn't only cost interest. It postpones every other goal waiting behind it. That's opportunity cost, not the purchase itself. The alternatives that disappeared because the purchase happened. Behavioral economists often describe this as a problem of visible rewards versus invisible rewards. The visible reward arrives today. You drive the car today. You sit in the larger apartment today. You hold the new phone today. The invisible reward asks for patience. An emergency fund isn't exciting. Watching an index fund grow by 1.2% over a month isn't exciting. Seeing your cash reserve cover 6 months of expenses isn't something anyone notices when they visit your home. One reward can be photographed. The other quietly changes your future. That's why one spreads across social media. The other stays inside a spreadsheet. There's another reason opportunity cost is so difficult to recognize. The future rarely asks for money all at once. It asks for options. The option to leave a job you no longer enjoy. The option to take 3 months off after having your first child. The option to move closer to aging parents. Most people believe those decisions will depend on courage. Sometimes they depend on liquidity. Because courage without financial flexibility often becomes wishful thinking. This is one of the quietest differences between people who appear equally successful from the outside. Two neighbors might both earn $90 a year. They drive similar cars. Their homes look nearly identical. They shop at the same grocery store. Their children attend the same schools. From the street, their lives look interchangeable. Inside their bank accounts, they're living completely different futures. One household spends almost everything it earns because every raise has already been claimed by a slightly more expensive version of life. The other household lets part of every raise remain unemployed for a while. Not because they don't know what to buy. Because they haven't decided what future deserves that money yet. From the outside, the difference is almost impossible to see. 10 years later, it's almost impossible not to. The cost becomes easier to recognize when life changes unexpectedly. Most financial plans are built around the assumption that tomorrow will look a lot like today. You'll keep the same job. You'll stay healthy. The car will keep running. The company will continue paying bonuses. Life has a habit of interrupting those assumptions. Sometimes the interruption is expensive. Sometimes it isn't. Sometimes it's simply an opportunity that arrives before you're financially prepared to say yes. A recruiter calls on a Wednesday afternoon. The position sounds interesting. The salary is almost the same. Maybe even slightly lower. 5 years ago you would have declined before the conversation even started. Now the decision feels more complicated, not because of the salary, because of your monthly commitments. The mortgage, the car payment, the private school tuition you agreed to last year, the renovation loan that still has 38 payments remaining. None of those decisions were mistakes, but together they quietly reduced your ability to choose. Financial freedom is often misunderstood. People imagine yachts, private jets, retiring at 40. For most households, financial freedom begins much earlier than that. It begins the first time money stops making decisions on your behalf. The ability to leave a bad job, the ability to take care of a sick parent, the ability to move to another city because your spouse receives a better opportunity. Those moments rarely appear on financial statements, yet they're often the moments that define an entire decade. Researchers studying household wealth have noticed something interesting. Income explains part of financial success. Savings explain another part, but flexibility explains far more than most people realize. Households with available cash don't simply survive emergencies better. They recognize opportunities faster, because every opportunity has a deadline. An investment property appears below market value. A friend starts a business and needs a partner. A company offers voluntary retirement with generous benefits. A dream home appears after months of searching. Opportunity rarely waits until your finances feel perfectly organized. It usually appears on an ordinary Tuesday. The same Tuesday your insurance premium increases. The same Tuesday your child needs braces. The same Tuesday your transmission starts making a noise you've never heard before. That's why opportunity cost isn't only about investments. It's about optionality. Economists sometimes describe money as stored purchasing power. That's true, but for most people, money is stored decision-making power. Every dollar sitting quietly in your account represents a future decision that hasn't been forced yet. Once that dollar is committed, so is part of your future. Think about the difference between owning a paid-off car and financing one. Both get you to work. Both keep the rain off your head. From the outside, they accomplish the same task. Financially, they create completely different futures. One requires next month's income before next month even begins. The other quietly returns part of that income back to you. Not as profit, as possibility. Possibility is difficult to appreciate because nothing happens immediately. You don't wake up feeling wealthier after making your final car payment. You simply notice that another $520 remains in your account at the end of the month. At first, it doesn't feel significant. Then another month passes. Then another. Eventually, you realize something changed. You stopped asking whether you could afford every unexpected expense. You started asking whether the expense was worth solving at all. That's a completely different relationship with money. People often believe wealth is measured by what someone owns. In reality, wealth is often measured by how many choices remain available after all the bills have been paid. Two people can earn exactly the same salary. One has already promised next year's income to yesterday's decisions. The other hasn't. From the outside, they look almost identical. Inside their calendars, their futures are nothing alike. There comes a moment when money stops being about numbers. It becomes about permission. Permission to stay. Permission to leave. Permission to wait. Or permission to say yes before the opportunity disappears. Most people don't notice when that shift happens. It usually arrives disguised as an ordinary conversation. A manager asks whether you're available to relocate. A close friend mentions they're looking for someone to help start a business. Your parents begin needing more help than they did last year. Your partner says, "What if we took a year off and traveled while we're still healthy enough to enjoy it?" None of those questions begin with money. Almost all of them end there. Because every meaningful decision eventually reaches the same place. Can we afford it? That question sounds simple. It rarely is. Sometimes, can we afford it really means, can we afford to lose one income for 6 months? Can we afford to move somewhere with a higher cost of living? Can we afford to take the risk if this doesn't work? Can we afford another year waiting? People often believe financial freedom arrives when they earn enough. For many households, it arrives when fewer dollars are already spoken for. Think about someone who earns $120 a year but has committed almost every paycheck before it arrives. A large mortgage, 2 car payments, private school tuition, vacation financing, credit card balances, home improvement loans. Their income is high, Their flexibility is low. Now think about someone earning $85. The apartment is smaller. The car is 8 years old. There are fewer monthly obligations. The emergency fund covers 8 months. Retirement contributions happen automatically. There is cash sitting quietly in a savings account with no immediate purpose. On paper, the first person earns much more. In practice, the second person owns something increasingly rare. Time to decide. This doesn't usually show up until life changes direction. The company announces restructuring. One department disappears. Everyone receives the same email at 8 o'clock on Monday morning. Some employees panic before lunch. Others update their resume that afternoon. A few quietly finish their coffee before opening LinkedIn. The difference isn't confidence, it's runway. Startups use the word runway to describe how long a business can survive before it runs out of cash. Households have runway too. Most people simply don't call it that. Runway is measured in months. How long could your current life continue if the paycheck stopped tomorrow? 1 month? 3 months? 6 months? 12 months? That number quietly changes almost every financial decision you'll ever make. Someone with 2 weeks of runway negotiates differently than someone with 12 months. Someone with no savings accepts almost any salary. Someone with a year's worth of expenses saved can afford to ask a different question. Is this actually the life I want? Money doesn't answer that question. It creates the space where the question can finally be asked honestly. That's why wealthy people often describe financial security differently than everyone else. They don't talk about buying more things. They talk about sleeping better, walking away from bad deals, ignoring unreasonable clients, turning down work they would have accepted 10 years earlier. Those are financial decisions. They just don't look like financial decisions from the outside. The strange part is that none of this usually begins with earning more. It begins much earlier. It begins the first time you decide that not every extra dollar needs a job immediately. Some dollars need time. Time to become options. Time to become flexibility. Time to become a future that hasn't been decided yet. Most people never receive a bill that says, "You no longer have enough freedom." Life doesn't send invoices like that. It simply offers fewer choices, 1 year at a time. There's a reason genuinely wealthy people often make financial decisions that seem confusing from the outside. Someone earning millions still drives a 6-year-old SUV. Another lives in the same house they bought 15 years ago. Someone else wears the same watch every day despite easily being able to afford something far more expensive. People usually assume they're being unusually disciplined. Sometimes that's true. More often, they're simply valuing something different. Once you've experienced enough life, status becomes a surprisingly poor investment. It demands constant spending, constant upgrading, constant comparison. The reward never lasts very long. Freedom works differently. Freedom compounds. The first month of expenses sitting safely in your savings account doesn't completely change your life. The second doesn't either. Neither does the third. But somewhere between knowing you could survive for 2 months without income and realizing you could survive for 12, something inside your decision-making changes. You stop rushing. Urgency begins disappearing from your financial life. You no longer feel pressured to accept every opportunity simply because it pays more. You begin noticing another cost that rarely appears in financial books. The cost of saying yes too often. A higher-paying job with a 90-minute commute. A promotion that quietly takes every weekend. A consulting client who doubles your income while cutting your evenings in half. None of those decisions are wrong. But every decision purchases a different version of your future. Money can buy comfort. It can buy convenience. It can buy experiences. What it can never buy back is a decade spent moving toward a destination you never consciously chose. That's why opportunity cost eventually stops being about dollars. It becomes about years. 1 year staying in work you no longer enjoy. 3 years postponing the business you wanted to start. 5 years waiting until life feels stable enough. Most people believe they're delaying those decisions. Sometimes, they're quietly replacing them. Behavioral economists have studied something called present bias. It's the tendency to value immediate rewards more highly than future ones. The future asks for patience. The present asks for almost nothing. Just one click, one signature, One monthly payment, one more subscription, one more upgrade, one more year. The future never argues back. That's why the present usually wins. Until one day, the future becomes the present. And suddenly you're 45 instead of 35. Your children are leaving home instead of learning to walk. Your parents need care instead of advice. The business idea has become someone else's company. The trip you kept postponing now depends on your health more than your schedule. Opportunity has a strange habit. It rarely disappears all at once. It quietly becomes unavailable. Not because life was unfair. Because every year spent waiting quietly removed one more option. This is why financial decisions deserve more respect than they usually receive. They're rarely about today's purchase. They're usually votes for tomorrow's life. Every recurring payment casts another vote. Every investment casts another vote. Every unnecessary upgrade casts another vote. The difficult part is that you don't see the election until years later. By then, most of the votes have already been counted. Several years from now, you probably won't remember what your checking account balance was this morning. You won't remember the exact amount of your utility bill. You won't remember whether your internet cost $79 or $92 a month. Those numbers disappear surprisingly fast. What stays are the decisions those numbers quietly made possible. The afternoon you left work early because your father needed to see a doctor. The month you took time off after your daughter was born without wondering how next month's bills would be paid. The phone call where you finally accepted a job because you wanted it, not because you desperately needed it. Those are financial moments. They just don't look like money while they're happening. People often imagine wealth as accumulation. A larger portfolio, a higher salary, a bigger house, a more expensive car. Those things can certainly be signs of wealth. They are not the experience of wealth. The experience feels much quieter. It feels like opening an email from your landlord announcing another rent increase, and realizing you have options. It feels like your car needing a $1.400 repair, and thinking about where you'll take it for service instead of wondering how you'll pay for it. It feels like turning down work that doesn't align with the life you're trying to build. Not because someone else can afford to. Because you finally can. That's a different kind of success. It doesn't usually attract attention. Nobody compliments your emergency fund. Nobody notices the investment account that quietly received another automatic contribution on the first of the month. Nobody applauds the decision to keep driving a perfectly reliable car for another 3 years. Those decisions are almost invisible. Until enough years pass, then they become impossible to miss. The interesting thing about opportunity cost is that it never asks you to be perfect. It only asks you to notice. To notice that every recurring payment is purchasing more than a product. It's purchasing a pattern. Every upgrade is purchasing a new baseline. Every dollar left uncommitted is purchasing another possibility. Most people spend years trying to earn more money. That's a worthwhile goal, but earning more and owning more options aren't always the same thing. Sometimes the biggest improvement in your financial life doesn't come from increasing your income. It comes from increasing the number of choices your current income can still buy. That's a very different way of measuring progress. Imagine looking at your bank account next Friday morning. The paycheck arrives just like it always does. The numbers are larger than they were a few years ago. Before you move any of that money. Before the automatic payments begin collecting it. Before another month quietly assigns every dollar a destination. Pause for a moment. Not to ask, what can I afford to buy? Ask something slightly different. What future does this dollar quietly belong to? Maybe the answer is today's rent. Maybe it's replacing tires before winter. Maybe it's taking your family on a vacation they've talked about for years. Money is meant to be used. No one is arguing otherwise. The question isn't whether you should spend it. The question is whether you're choosing the future you're paying for, or simply accepting the one that arrived by default. Because every financial decision creates two versions of tomorrow. The one you decided to build, and the one you quietly gave away. The difficult part is that you'll never get to live both. So the next time you spend money, don't just look at what you're buying. Look at what you're no longer able to buy. Sometimes, that's where the real price has been hiding all along.